What's up, welcome back to Koh Samui in Thailand. I'm at the restaurant here at the hotel. Just finished breakfast, and now it's time to record some videos. So I decided I would record this video today inside because it's super hot outside. It's only like 9:30 a.m. It's really crazy hot. But today I'll share with you basically 3 ways to scale into trades. Now, it's a topic that came highly requested on my YouTube channel when I asked a survey recently about what people were looking for to learn or to improve. And the number one thing was basically execution, better entry, better exit. And that is something I can help you, first of all, get better entry. And in the next video, we'll talk about things you can do to be able to scale out of the trade in a better way, properly. So I want to share some things with you today on the charts. Some things will be just spoken, but I think this topic needs some examples on the chart. Here we go. So there's 3 ways to be able to enter trades and scale into trades. And that means that you don't enter your trades all at once, like most people. You actually take a step back and enter trades progressively, which will ideally give you some edge and will keep you out of some bad trades and make sure you maximize your profit on good trades. So I've got 3 ways. The first way is to scale in on trades based on retest of certain levels. So let's go on the chart. I'll show you what that looks like. Okay, so here we go with entering on retest, and this one is quite simple. I think it's the one that most people talk about, so we'll just go through it quickly. Basically what that would be is you have a trade, and here in this example we have a breakout trade, so price was in the range for a long time, and then we end up breaking out of the range. So in that case, what that would mean is that you would enter around this level here when price breaks out of the range. And let's say you just enter beyond this high. So your first entry would be here. And now price moves in your favor a little bit, but then comes back down quite quickly. Okay, your stop loss would be maybe around here, below the candlestick that broke out of the range. And so now you would want to enter back on this trade. You would want to enter on the retest. And that means that you would let price go here in your favor. That price comes down. And when price hit around this level, okay, you could decide how you enter this, but let's say we just enter right at the range level. So let's say here. That will be when you trigger your second position. And you could use the same stop loss if you want, or different stop loss. In that case, that might not be the ideal example. Price comes back down a little bit. But depending how you enter this, maybe your range was a bit lower, maybe you adjust this a little bit. Actually, the range might be like a little bit lower on this example, but you get the principle. The principle is you enter on the retest, and that means that your first trade is in profit. You enter the second one because it's more likely to go up right now, and that's how you would enter trades. Okay, this is not the best one because the fact that it's quite risky, in the sense that if price is going to kind of go back here and crash against you, then you have your full loss. So you have your 2 positions in loss. So this one, for the second one, and your first position here, they will both be in loss, and that's not good, of course. So those are the ways you can go about this, and let's go on to the second method. The second way to scale in on your trades is by entering with a feeler in the market. Now, feeler is not something that's very common in trading, especially for retail traders, more for professional traders, but here's what that will look like on a chart. So in the second method, the feeler, what we do is we'll take the first example here, the same one, and then we'll compare with other examples as well after that. So what a feeler is a small position you place in the market, and that position is going to allow you to see how the pair performs. And it's a fact that if you are in a position on a trade, no matter what the size, you're more likely to pay attention to what price does on that pair. If you're not in the trade, then you just like not necessarily care about it that much. And that's why the feeler is important. So what some professional traders will do, especially in banks or big institutions, is that they will enter a small size anywhere, like for example somewhere in the range, and they will monitor that position. If it's up a lot, they will see that price move in their favor, and then they could trigger a second position that's going to be much bigger. So let's say our trade size is 1 lot. Let's just go with that. So we enter usually 1 lot per trade. Now what we'll do is we'll break this down a lot, and we could say, for example, that on a particular trade we'll use a feeler of, for example, 0.1 lot. Okay, so it's only 10% of our size that we use on any given trade as a feeler, and if we lose it, not that bad, it's just a small position. And so let's say we see price here coming to the top of the range. That sounds interesting. We just enter here on the feeler. Okay, 0.1 lot, we're in. We'll see the price move in our favor or not. Could come back down, doesn't really matter there. And usually these feelers, they only have a tight stop loss. They have quite a big stop loss or no stop loss at all, just to see what price does. So let's say you put your stop loss here, or maybe even below the range. Okay, just as a, it's not there to kind of make a big loss, just there to kind of see how price performs. Now what we'll do is we'll wait for price to move, and we'll monitor our feeler or small position. So we'll see if price go up here and then breaking the range. Okay, we'll see this clearly because our feeler is going to have a really big win at that point compared to what it had before. So we see price breaking out of the range, and then we could enter here, let's say at the break, like we said before, we could enter here our second position. So the last 0.9 lot that we have to enter. Okay, and that's the one you enter, and it's not very clear, but this is 0.9. We enter here on the right setup you set up for your strategy, and then you wait for price to go in your favor. Okay, so that's not really a way to scale in that much per se, but it's a way to monitor a trade before you enter, and then having a way where you enter your full size when you're sure that price is in your favor. Okay, so that's just a way to do it, and maybe you don't want to use that. Like I'm thinking 1/10 here on a feeler, that might be a little bit high. You might want to use maybe half of that, so 0.05 lot on your feeler, something like that, and then you decide what you want to do with it. But that's the second way, not a very convenient way, but in banks they really like it, so that's something that a lot of people do when they trade professionally. But now it's time to go to the third way of scaling in your trades. And finally, the last way to scale in on your trades is through entering trades when your profits are locked. That is for me the ideal way, so let's have a look at what that looks like. So now for the third way of scaling in your trades, I want to take the same example first and then we'll move to a different one after. I don't think we needed to do that with the previous example on the feeler because that's something that most people won't use. But this one I really want to kind of show it on different aspect and different type of setups in the market. That one is about profit locked. So that means that when your profits are locked, you can add into your trades. And the way it's going to work is quite simple. So you wait for price to break the range. That's going to be your first entry. You enter here, like we said before, beyond the break of the range, stop loss here. And now what we'll do is we'll move the stop loss in your favor as price goes in your favor. And the way you do this is you wait for price to hit. So price goes there, come back down, come back up, and it makes a new low. So you will move your stop loss up in that case because it's a buy trade as price makes a higher low. And you move your stop loss where? Well, to the previous low. So when price gets here, we move your stop loss here. Okay, it's not a big jump, but it's decent, right? Now we'll wait for price to go in favor. Price makes a new low here. Therefore, we'll move the stop loss here at the previous low. Okay, and so on. Price makes an equal low, we don't do anything. Price goes there, makes a new low here. We'll move the stop loss around this level. Okay, now price goes in favor again, and now we'll see that we're here pretty much break even, right? We entered there, and now our stop loss is above there. So what we'll do is we could add here a trade. You might want to see like the same setup appearing or something different. But let's just see here we have this breakout. See we have this range. And then we get a breakout of that range around here. So you can enter this on a breakout, put your stop loss below there. Remember, so you have one stop loss here for your first trade, second stop loss here, your second trade, and one entry here, one entry back there. Okay, so now you just have to wait for price to go in your favor. So you enter here at the break, price comes down a little bit, right, goes in your favor. So here you make a new low. You can move your stop loss that was here. This one is the old one, goes there. The new one could also go here if you want. A little bit risky because it's really close, but you could also move your stop loss there if you want. So two stop loss are here. You have one trade there, one trade taken here. Okay, so you almost break even on the second trade. Now price moving in your favor, makes a new low. There we go. And now you could move your stop loss, these two stop loss. You move them here. Okay, it's maybe a little bit messy with the drawings, but basically you have one trade here that's been in profit quite a bit, and the second trade here that you've entered on the breakout there, that is now also in profit and locked in. Okay, now you could decide you want to add more to your trade or not. You could do that if you want, if you really want to be aggressive. But let's say we just limit our maximum entry on a trade to like 2 trades. Okay, now price is there. And now price makes a lower low. Okay, this is where you could decide to exit the trade. I'll do a video really shortly about how to scale out of trades. Okay, so make sure you subscribe to be able to see this video. It's going to come really soon. And that video will teach you how to get out of trades and what signs you can use to get out of trades, basically, to be able to maximize the profit. That could be one way to do it. Okay, I'll just share more in the future. Now, what price does is it kind of goes back up again, but comes back down, and you'll be stopped out around here. Okay, so if you didn't exit the trade there, you'll be stepped out pretty soon. Okay. Now, there's other ways you can go about this, so make sure you watch a video that I'll publish shortly about how to scale out of trades. That's the principle. So, let's say you were to add one more trade there. Okay, so you both are locked into profit. What if you add one more trade? Well, you would enter on the same principle. Maybe here you enter like on the retest, right? This is a retest. You could enter there, let's say when we get here. Or maybe let's not make it too in your favor. Let's say we enter here after this big bullish candle. So we enter there, put a stop loss. We have 3 stop losses here because of our new size or new trade. Now price moves in your favor, makes new low. In that case, we cannot really move anything. Stop loss will still stay here. And then price goes up, comes back down again, same low. So we cannot do anything. Price goes up. You could say this is like a new low. So let's say you move your stop losses to this level there. Okay, so all these 3 stop loss, they all go there. And then basically what happens is that you would close your trade here, and one of your position would be break even, let's say, because you entered there. Okay, so it's about the same. And then the other trade, the other 2 ones will be in profit quite a bit. So let's just calculate this quickly. You entered one on the breakout, this one right there. Let's calculate what that would give us. This will be around a 2-to-1, given that we have a big stop loss when it started. See, we were all the way to here, and that's pretty big of a stop loss. But the other trade, I think, will be more favorable because we had a smaller stop loss. So that one, we entered it here on the breakout of this range, and we got out around there, and we had a stop loss here. So we had about the same, I think, or actually one. So lower reward to risk in that given circumstances, but if we were to find a way to get out here toward the top, then we're going to get a bigger reward to risk. But of course we won't do that now. So that's about how things go. Okay, you could also be more aggressive and say when price breaks the low it makes, like we had here, you could exit here at this level. Okay, that could be a way. That's what we'll cover in the video on how to scale out. But basically we have here a 2-to-1 and 1-to-1. So we're doing decent on that. And not much risk because we only had a small risk at first, and then the risk got better over time because we always enter trades when profits are locked. Let's look at another example. Here we go on AUD NZD, Australian dollar, New Zealand dollar. This is a trade that I took recently that worked out well. I want to show you how you could scale into that trade to get even better results. So here is the daily chart, and basically you'll set price at a resistance area here on the daily chart, hitting that point. So what we'll do is we'll go on the time frame, we'll trade that pair. I've entered this on a 1-hour chart, I believe. So let's just go on the 1-hour chart. We should be able to see the setup right there. There we go. The setup we have is an engulfing candle here, breaking the Bollinger Band. No Bollinger Band on the chart here, but it breaks it, trust me. I'll just put it here quickly, so you see the break. Now we have a nice break. Now let's say we want to use the Bollinger Band to be able to scale into our trades. Or maybe we want to use the same setup we had before to scale in the trades. That would work out pretty well. So I'm going to delete this here. Actually, yeah, we'll delete that part. What we'll do is we'll enter our first trade at the regular position, the regular point, which is here. Enter below the low, stop loss beyond the high. And now we see price going in a direction pretty quickly. Okay, we retest here a little bit. And that would be a way to enter on retest, which we talked about before. The first way is to enter on a retest, which we had here. But let's say we don't do that. We have price in our favor. Okay, our stop loss is there, and we'll move the stop loss the same way we did before, with price making lower highs in that case. So price goes down here. Actually, price makes a lower high here, but we don't do it. Lower high here. So we'll move the stop loss here, and we'll be safe. Price goes here, lower high a little bit, not much. We can move the stop loss here. So this one goes there. And from this point, we are in profit. So we're good to go. Now, what we could do is we could enter on similar trade setups, which we have over here. We have the same setup, okay, which you see with the red triangle that we had over here. We're going to enter that. So enter below the low, stop loss beyond the high. Or what you could do too is you can just enter the market right away when you move your stop loss. That could be a way to do it as well. You might enter a little bit earlier. In that case, we want to be more precise with actual setups. So price goes there, makes a new low. Now we can move this stop loss here to there. The second stop loss for our second trade stays there. It goes in our favor. Price makes again a new low here. Price makes again a new high here. Move a stop loss. Move both stop loss over here. You could be more aggressive there because we had these lows here, but I tend to be more conservative a little bit. Now price goes again here the same, makes this low. You can move everything now there, and then your profits are locked in. Price makes this low, comes back making this high. You could move everything there, and now we're playing really tight. Okay, we don't have much room for error. And then price steps us out right here. Okay, so overall we had two trades. I think this was pretty good, turned out to be pretty good. Let's see how that turned out. And this is, by the way, making a lot more profit than I do with my trades. So I tend to get a take profit of 1-to-1 of your to risk and 3-to-1. So I will get an average of 2-to-1. Let's see if we can beat that here with this particular setup. So we did a short. We entered there the first one. There we go. The first one will have given us a big 3.6-to-1, which is really good. And that's the first trade. Second trade, which we entered over here on the second setup. Actually over there. Similar stop loss. This one will have given us a small reward to risk of about 1-to-15, 1.10-to-1. Okay, not big, but definitely better than a 1-to-1 and 3-to-1 in that case. And we were locked in all the way, which means this trade lasted a long time, but we didn't lose any profit on that. So we were locked in all the time, except on our first trade. But after that, everything was locked in, and we had no risk of losing anything pretty much. So this is really good. So there you go. Here are the three ways you can scale in on your trades and be able to maximize your profit by not entering too early with your full size, and making sure that if price will not go in your direction, that you're out of the trade or only with a small position on your trade. So I hope that makes sense. Leave me your thoughts below in the comment section. Tell me which method you prefer to use, or which you would prefer to use if you were to use one. And I suggest implement that in trading in the future. Test it out, see how that works. I personally prefer the profit lock method, where you enter when your profits are locked and you have no way to basically lose more money. But you decide what you want to use, of course, it's up to you, and that's going to depend on different strategies. So here are a few comments for the past video. I appreciate you guys for leaving comments as always in the comment section. And I'll catch you back here in Koh Samui or maybe in Bangkok tomorrow. Ciao.